It's time for Global Insight. US consumer prices once again surged in August, further stirring up inflation amid rising costs for rent and healthcare. Inflation, it seems, is everywhere, though different in nature. Economies across Asia, Europe and the United States are experiencing rising price levels that central banks have been chasing for months, but to no avail. As the Ukraine war continues, holding up energy supplies for Europe and job market figures and persistent inflation in the US point towards a hard landing recession, the outlook for the world economy is largely pessimistic. The Chief of the European Central Bank, Christine Lagarde, said economic growth in the area is facing a really dark downside scenario. So just how downward are we talking and how will this affect the world economy? To discuss these issues, we're joined by Christopher HARTWELL, Professor of International Business Policy at ZHAW School of Management and Law, and Tuan, US Economist at RSM. Very warm welcome to you both. Thank you for joining us. And well, my first question to you, Professor HARTWELL. Now, several European countries, including the region's largest economy, Germany, built up a decades-long dependence on Russian energy. Just how much did major European industries depend on Russian gas to grow their economies, and which industries are being affected the most at the moment?
Yeah, now this is a very good question because it puts into kind of perspective the fact that Germany, Austria, Italy, Hungary, even France to some extent have really been living on borrowed time when it comes to energy from Russia, that there hasn't been any move towards diversification. There hasn't been any move towards weaning themselves off of what was inherently an unstable country, an authoritarian country, which people had seen long time coming. I mean, we had seen Crimea in 2014 and the first invasion of Ukraine. There's been plenty of time to kind of move away from sole reliance on Russia, but it hasn't been done. And kind of concurrent with this has been this rush towards renewables and green energy and a transition which honestly isn't quite ready yet. So they've been operating underneath this umbrella of Russian gas for a long time. We see industries and sectors such as metals, such as mining, more indirect in terms of kind of processing, textiles, even food, have become addicted to this Russian energy source. It's going to hurt with Russia turning off the taps. It can diversify. Germany, other countries in the EU can diversify, but it's something that they should have done a long time ago.
And Dr. Tuan, well, the US, it seems to be seeing consumer consumer spending sort of trimming down, but we saw consumer prices spike again very unexpectedly in August. And well, US rental inflation as well, it's been growing as shelter costs rose about 0.7%, and that actually marked the biggest monthly increase since 1991. What do you make of these different signals? Do you think consumer prices will start to subside?
After a year and a half of robust growth in the US since 2020, I think the US is heading toward a slower growth period due to inflation and tightening monetary policy from the Federal Reserve. However, consumer spending is still on a very solid ground due to a strong labor market that we're having at the moment. Now, the labor market is so strong at the moment that the Federal Reserve should worry about wage inflation, another type of inflation that everybody is talking about. But the strong labor market gives a very solid foundation for spending because it gives somewhat stable wage income for consumers at the moment. But again, that does not come without a hefty price tag in terms of wage inflation. We begin to see some of that impact in today's inflation data, especially when you look at the core inflation components, when you strip out energy, when you strip out food inflation, food prices. And I think with today's data, we can continue to see the inflation fight to last a little bit longer.
And Dr. Yuan, how do you see the risk of gas prices spiking again for US consumers?
In my opinion, gas prices and energy prices in general are still too high compared to the pre-pandemic level. However, in my opinion, I don't think there's going to be a similar significant spike in gasoline energy prices as the one we saw at the onset of the Ukraine war. However, the geopolitical uncertainties around the Ukraine war, the slowdown of the Chinese economy, and the incoming recession in Europe, I think gasoline prices and energy prices will continue to be highly volatile.
And Professor Hartwell, as Europe faces a cost of living crisis, Germany, Sweden, France and Britain, they all announced sweeping billion-dollar relief measures to ease the strain on households and businesses, as well as rationing and conservation plans. Do you think these plans are actually going to work?
Disaster. Absolutely disastrous plans. First off, you see what like you have in the United States. Today, Biden was doing his victory lap on this Inflation Reduction Act, when in reality it's going to be the Inflation Acceleration Act. It's going to be pumping more money into the economy at a point where it's already overheating. You're going to have the exact same effect if you do this in Europe. We've had 14 years of far too accommodative monetary policy. The global financial crisis was 14 years ago, and we've had zero interest rates, we've had asset buybacks, we've had just quantitative easing infinity, just flooding the markets with liquidity. If you're going to go this fiscal route now, you're augmenting monetary policy, which is still too accommodative. We're starting to get off the zero lower bound. That's fantastic. We should have done that a long time ago. But capital isn't being priced accordingly, and now we're adding fiscal stimulus on top of this. Like you said, it's going to be a hard landing. And any type of cushion that is being proposed now in terms of more spending, more fiscal accommodation, is just going to prolong the agony in the long term.
And Dr. Nguyen, well, the Eurozone, the United States and China, they all together account for roughly 2/3 of the planet's economic activity. And if these powerhouses slow down, then it would be hard for any country in the world to remain somewhat insulated from the fallout. So how do you think East Asian economies, including South Korea's, would be affected?
East Asian countries like South Korea and Japan share a lot of similarities with the US economy. So historically speaking, whenever we see a slowdown in the US economy, we see a spillover effect on developed countries like South Korea and Japan. However, at the moment, I think the more concerning problems is via the exchange rate channel. As the US dollar continues to become stronger against the Korean won and the Japanese yen. A stronger dollar essentially means a weaker Korean won and a weaker Japanese yen, putting more pressure on the central banks of those two countries in terms of monetary policies when you have to balance between growth and inflation, and further complicate the inflation problems in Korea and Japan.
Right, and South Korea's own Bank of Korea governor actually said that the country's monetary policy is independent from the government, but it's not independent from the US Fed. And Dr. Nguyen, well, the Fed's expected to raise rates again at its next meeting. And do you think it's going to gradually slow down the pace of its rate hikes, or do you think it's going to continue with this aggressive approach?
Given today's data on CPI and inflation, I think another aggressive interest rate increase of 75 basis points has been cemented. However, until November, we still have a lot of time and a lot of data points coming out. And we all know by now that the Federal Reserve has been very data driven. So we think potentially the Federal Reserve could potentially slow down to 50 basis point rate hikes in the last two meetings of the year, bringing the policy rate to around 4% or a little bit above 4% by year's end. Now, even though we see a slowdown to 50 basis points, to put into historical context, is still very aggressive. And I think that any kind of speculation, very important, that beyond that timeline, the 3-month timeline, should be politely dismissed, because to be honest, even for the Federal Reserve, they don't even know that what they will do in the next 6 or 12 months, because again, they have to be data driven. And I think the Fed has sent a very clear message to everybody in the market that it will not stop being aggressive until inflation is meaningful under control.
And well, Professor Hartwell, the European Central Bank last Thursday, they raised their key interest rates by 75 basis to 0.75% from zero and lifted its main refinancing rate to 1.25%, which is the highest level for both rates since 2011. And well, do you think this is going to help cool down price levels at all?
Well, the problem is that the EU, the ECB, is always following the Fed. It's always playing catch up. The Fed is primus inter pares, first among equals when it comes to setting kind of global monetary policy. The ECB is playing catch up. The ECB did a lot more in terms of its quantitative easing policies, in terms of its asset buybacks, in terms of intervening in corporate bond markets, for example. I think, and the ECB has also not signaled, just like Professor Nguyen said, the same kind of aggressiveness that the US Federal Reserve has. The ECB has always been more dovish. They've always been more willing to accommodate a little bit more inflation for a little less unemployment, kind of your famous Phillips curve relationship. I think the problem within the Eurozone is that inflationary expectations are becoming steadily entrenched. And once that happens, then you're going to have self-fulfilling prophecies when it comes to inflation. If inflationary expectations are going to be ratcheting up, then it's going to be much more difficult for the ECB to kind of to slow walk its rate rises like it's doing now. And I think just coming off of the zero lower bound, coming up to 0.75 is nowhere near enough to kind of dislodge these expectations because they are becoming entrenched.
Professor Hartwell, really not helping the situation is the Russian gas company really fiddling around with the gas supplies going to Europe. And well, do you see Russian President Vladimir Putin as weaponizing energy as a strategy to really disintegrate European unity, as many Western leaders are saying? And if so, as long as this strategy continues, then how do you think Europe will really have to safeguard its economy?
Well, I mean, Putin has been doing this for 20 years. He's been using energy as a weapon. He's made no secret of he wishes to wield it as a weapon. I mean, all of the Russian economy is subordinated to political aims underneath Vladimir Putin. Politics first, economics later. So this isn't really a surprise. What Vladimir Putin has done, and someone posted this on Twitter earlier today, they said that he has to be a CIA plant because he is starting to wean Germany and Western Europe off of Russian gas. He's forged Ukrainian unity. He's revitalized NATO. He's just been brilliant for Western Europe. And I think this is something we really have to consider is that, as I mentioned at the beginning, Germany would have continued to be heavily dependent on Russian gas, probably in perpetuity. This is Merkel's legacy. But the fact of the matter is now that Finland, Germany, Austria, Italy, France know that they have to diversify. Latvia especially know that they have to diversify away from Russian gas. So the more that Putin wields the weapon of energy, the less effective it is going to be in the future.
And Dr. Yuan, while revisiting what Professor Hartwell said, do you think President Joe Biden's plan to grow the bio industry in America, do you think it's really going to help with the economic situation in America at all?
So I think the industrial policies in America right now can potentially help with the productivity problems that we have been seeing in the U.S. in the past couple of years. That whenever we have supply problems and the demand problems, investing in productivity, investing in new technologies is going to be the move forward, especially to tame inflation, because we all want to see that supply chain disruption going away. We all want to see that productivity measure going up.
Right, I see. Well, two conflicting opinions there. And well, in the meantime, Professor Hartwell, in Germany, though, being at very much the heart of the European economy, if it does experience a slowdown in growth, then what would it mean for the rest of the Eurozone?
Well, the joke with the United States always was the United States sneezes and Latin America catches a cold. I think you probably see something fairly similar within the Eurozone especially, but in the broader European Union. But I think there's been, where we live in interesting times, I think there's been a great kind of not deglobalization, but kind of decoupling from global supply chains that's been occasioned by COVID-19. There's been a lot more kind of looking inward. So I think the linkages, the financial linkages are there, but some of the trade and cross-border linkages, which people took for granted before COVID-19, are very slowly coming back online. So I don't think there's going to be the same kind of amount of contagion. That being said, Germany is the largest engine of growth within the Eurozone, within the EU. So it will cause problems for, especially for countries like Poland, which heavily rely on Germany. But I think there's enough of a realization of what can happen in a crisis situation, again, shown by COVID-19, that there's a bit more resilience in the system than there was before.
I see, and well, obviously South Korea isn't going to be insulated from the impact as the US and EU economies really take a hit. And well, I'm afraid this is where we'll have to leave the interview today. That was Christopher HARTWELL, Professor of International Business Policy at ZHAW School of Management and Law, and Tuan NGUYEN, US Economist at RSM. Thank you both so much for joining us today.
Thank you.
Thank you.